This is Bloomberg Intelligence.
The new tools that a metaverse can bring allows you to create more immersive content.
Companies are beginning to sell less oil, more electrons.
In-depth research and data on 2,000 companies and 130 industries.
The supply chain breakdown is combining with labor shortages.
Will Eastern manufacturers continue to dominate, or will there be a renewed interest in Western manufacturing?
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Hello, I'm Kriti Gupta in for Paul Sweeney. Over the next hour, we'll dig inside the biggest business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we focus on earnings from oil and gas companies to casinos and hotels, plus how the war in Ukraine is impacting European packaged goods. But first, as low-cost beta ETFs take over the core of portfolios, investors showing less interest in active funds. That's according to Bloomberg Intelligence senior ETF analyst Eric Balchunas. Eric, thank you for joining us. Talk to us about this dynamic. Why are they showing less interest in active funds?
Yeah, well, it's been a story playing out for a couple decades, but it's really reached fever pitch. And so we wrote a note basically we're trying to advance this conversation and give our take on it. And our take is that active is not dead at all, but it is evolving. And the reason it's evolving is because over the years, people have gone from sort of buying one hot manager and then, selling that manager when they underperform and buying another one. That was what happened in the 90s. Now people have just sort of settled into owning an index fund in the core of their portfolio or a cheap ETF. The value proposition of owning the whole market for a couple of basis points is just so strong that people are resigned to just saying, I'm going to just own the whole market and really save on costs, and I'll look at that as my excess return. But that is a very boring way to invest, and for many people, they want to put on stuff on top of that, almost like putting hot sauce on a very dull meal. And so what we found is that when you think about active management, it used to be about getting alpha. Now it's about providing active share, which is just basically that how different you are from the benchmark. This is why we've seen a rise in ARK, and not only a rise in ARK, but a staying power. ARK has seen inflows this year. It's shocking everybody, but it's because of Vanguard and passive taking over the core. People have much more tolerance for volatility because it's only a small portion. This is also going to help thematic ETF investing a lot. And so we're bullish on high active, share active, and thematic investing, and package trades, things that maybe go long this and short that to provide a solution. To us, that's the future of active. And it's probably pretty stunning because a lot of CFAs, have learned about, alpha and how to get it. But right now, alpha may not even be that important. It might be more important is how different of an exposure can you serve up so you can complement that cheap index fund core that people seem to be settled on for the time being.
Eric, I'm so glad you mentioned thematic ETFs because I think you're 100% right when you've seen kind of this increase in them from the trade war ETF to the marijuana mania ETF. So many really targeting these themes that I think a lot of people are trading off. I mean, the triple Q ETF is the one that comes to mind immediately. But I'm curious, though, if that creates a margin for error because I think not all companies are perhaps created equal. So when you see this drive into one particular sector or thematic ETF, does it create a margin of error in terms of getting exposure to a company that perhaps may not be as strong fundamentally?
Yeah, sure. And this is what people complain about with Cathie Wood all the time. Cathie Wood and ARK seems to get hit from the vantage point of a very reasonable fundamental investor. They're like, why would you own all these non-profitable tech stocks? Yada, yada, yada. It makes no sense. The problem is, as I mentioned earlier, people already own all of the serious investor, fundamentally sound stocks in the index fund. They got Apple and Amazon, and all those guys are in their index fund. So they kind of want wild and crazy out there. It's almost like the way you would view a call option. You're spending a little money for the possibility of some serious upside potential. Again, I also think making crypto popular and giving people a lot of tolerance over its volatility because there's a possibility that it could go to, $100,000 or whatever. So I think this lottery ticket phenomenon is here to stay as long as Vanguard is around. And for themes, that's very good for them because a lot of these companies, there's not going to be a ton of great fundamentals yet. We just wrote about the psychedelics ETF. That's a bunch of micro-cap stocks that have no earnings. I mean, it's really risky. But I would also say if you are going to go out there, an ETF does dampen your volatility a little bit because if you own 10 stocks or 20 or 30, you're going to cut the overall volatility versus, say, one of the stocks. right? So I think the ETF and doing thematic investing through an ETF actually does make a little bit more sense than trying to pick one. Although obviously if you pick the right thematic stock, that's a real lottery ticket, but that could blow up too. So I think people are looking at ETFs to do the thematic investing, and also the ETF industry is pretty good about serving up all the latest stuff for people to choose from. But again, I don't see this as being a serious investing pursuit. I see it more as a distraction, the chance for some big returns. People like narratives. But the good news is I don't think people are using this for the core of their portfolio. Again, they already own everything with the index fund. So that is why we're going to continue to see the more passive rises, the crazier and wackier and wild and more narrative-driven the ETFs are going to be that they get launched, ironically.
So does it sound like to you that maybe not in the near term, but in the longer term, being an active stock picker will kind of make a comeback?
It's tough to say. Again, I think it'll make a comeback if they can just lower the fees. Right now, the asset-weighted average stock mutual fund is 66 basis points, and they probably have another 60 basis points of trading fees. So they have to get over that just to get even. Once those fees come down a lot, I think they'll probably have a comeback. Also, again, I think there'll be a big lane wide open for stock pickers that can find areas of the market not covered by the index. And people will be looking for that. They want that excitement. They want that a chance at a huge upside. So it's not dead, but it is shifting to playing a more supporting role in the portfolio.
Well, Bloomberg Intelligence analyst Eric Balchunas, we thank you so much for your time, for your wisdom, as always. Coming up on the program, how the war in Ukraine is putting pressure on European packaged food companies. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Kriti Gupta, in for Paul Sweeney. It's 13 minutes past the hour. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
I'm Kriti Gupta, in for Paul Sweeney. The war in Ukraine has put additional cost pressures on European packaged food companies such as Nestle and Danone, given their exposure to key soft commodities. That's according to Bloomberg Intelligence senior analyst Duncan Fox. Duncan joins us now. Duncan, thank you as always. I'm interested in this exposure to commodity prices. How much of that rise that we're seeing in the agricultural space is going to be eating into the margins of some of these companies?
Well, it does depend how well they can push prices through for the rest of the year. We've seen anything from sort of 3 to maybe even 5% from some of the companies already, but that's just sort of ticking off what came through last year when there was a La Nina phenomena. So you've got to do at least the same again through the rest of 2022, just to sort of stay square, frankly. So you could be seeing another sort of 100, 200 basis points on gross margin if things stay as they are now or get worse.
So how does, I should say, these companies really prepare for perhaps some of eating into that margin? Because if you start to hedge, or I should say not hedge, some of these commodities, at some point you kind of have to cut back on your buying of them, no?
Well, I think some companies last year, certainly because of other supply chain issues, started to buy some buffer stock. There's no doubt you saw working capital improve and inventory get larger. So they've probably got a little bit more buffer than they would have had maybe 2 years ago before COVID occurred. The biggest fear, I suppose, for them is certain things like edible oils. That market has pretty much imploded because 60% of it was Russia and Ukraine. So the only thing you can do there is either find canola or rapeseed oil, which isn't going to be that easy, or put new products together. And that just takes time, and you've got to go through regulation and taste, try and get the taste profiles right. So all you can do is really push up prices. If you've got the balance sheet, you can then do some promotional spend, hopefully keep people interested. But everybody is in the same boat. So, I mean, prices are going to have to go up. It's a question of whether we, the consumer, trade to lower priced products, which is starting to happen a little bit now, if you believe newspapers around Europe.
Well, it sounds like you're talking about demand destruction, which is a key point I want to come back to. But I really want to harp on a figure that you mentioned, Russia and Ukraine making up about 60% of sunflower oil production. The EU comes third in that. 20% of it comes from the European subcontinent, essentially. Is there incentive from some of these European packaged food companies to localize their supply chain, essentially help the EU get more of that market share when it comes to sunflower oil production, and at the same time eliminate some of those lengthy supply chain issues?
I think that's what they were trying to do last year as the various supply chain issues happened, but it's not something you can do overnight. If you wanted to replace that sort of level of land, you're putting an enormous amount of new hectarage down for the sunflower oil, but then you're taking that land away from something else. Now, to be fair, Europe and the US is going to allow set-aside land. It's about 15% in Europe, and it's about 9% of the US for farmers to plant, but I couldn't tell you whether that's going to be productive land at all. Fertilizer prices have gone through the roof because of oil and energy costs. So actually being able to get the yield up from that land could take years. So it's not there's no short-term solution here, I think, is the biggest problem for the companies. But I think that's the way they'll go. They'll try and secure their supply chains much more where they have their sales.
Well, let's come back to the point of demand destruction, because this, of course, is something that we've heard from a lot of European citizens and reporters, the idea that the cost of living crisis is enormous when it comes to the UK and arguably other countries in the European subcontinent as well. I'm curious, though, if to some extent the stock of these companies, Nestle, Dan, that we're talking about, is somewhat insulated, given that this is food, after all. People have to eat.
That's true, and I think I said it earlier, even private label companies that may be offering a similar product 15-20% cheaper, they've got the same input cost pressures. So it's really a case of whether wages go up quickly enough or whether we, the consumer, decide to sort of trade out of something else, whether we go on cheaper holidays or maybe not go out to restaurants, etc. as much. But ironically, that would impact these companies as well, because probably somewhere between 15 and 25% of their sales go to the hotel restaurant trade, and they're generally higher margin sales. So there is going to be an issue if people do eat at home more, as we saw during COVID. They picked up the retail sales, but losing food service really did hurt the margin, and some of the benefit they were getting last year was those clients reopening. So it's really quite tricky to know exactly how we, the consumer, will do over the next year, but something's got to give. You've only got 100% of your money to spend, and food's going to take up 3, 4, 5% more than it did a year ago, comfortably.
Duncan, let's talk about the health of some of these companies. I think 2020 and arguably the first half of 2021 was a time period of record debt issuance, but also record profits just given by fiscal stimulus in Europe and the United States and arguably several other countries as well. Does that give some insulation to the stock here?
Possibly, but the record profits were helped because quite a lot of investment was pulled in terms of advertising, marketing, etc. Now, they could do that again, but actually it's not a very good long-term thing for a company to do. You need to keep your brand front and center of consumers' minds. So most companies in the second half of last year were actually putting that investment back into the market as economies normalized. So I think taking it away again would be a very bad decision. It's really got to be that they get their pricing right for the right product and do it at the right time. I think companies that have moved early are going to be far better placed than ones that are trying to push prices through now. They may have almost missed that sort of first round of pricing and have to take the extra costs on the chin. So if they do cut marketing, I would take that as a bad sign for the medium term, because it's real short-termism, I think, to keep profits moving.
Well, Bloomberg Intelligence analyst Duncan Fox, always a pleasure to have you join us. Thank you so much. Coming up on the program, we go inside the turnaround at Molson Coors. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the Bloomberg terminal. I'm Kriti Gupta, in for Paul Sweeney. It's 25 minutes past the hour. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
I'm Kriti Gupta, in for Paul Sweeney. We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts covering some 2,000 companies and 130 industries worldwide. Molson Coors may be on the brink of an upgrade thanks to a long list of improving metrics. That's according to Bloomberg Intelligence senior credit analyst Mary Ross Gilbert. She joins us now. Mary, thank you as always for taking the time. Let's start off with a very simple question, or simple for me, maybe not simple for you. Give us a breakdown on Molson Coors' balance sheet today.
Hi, Kriti. Yes, thank you for that. So Molson Coors, as we know it, was created in 2016 when Molson Coors acquired the remaining 58% stake of Miller's Coors it didn't already own from SAB Miller for $12 billion, taking on about $7 billion of debt. This raised its total debt to about $12 billion, which was almost 5 times combined EBITDA. That's earnings before interest, taxes, depreciation. After losing market share over the next 5 years amid a slump in U.S. beer consumption, at least until COVID, then the loss of sales from bars and restaurants on shutdowns, Molson Coors' EBITDA fell about 17%. However, thanks to the company's high cash conversion, which we define as excess cash flow after dividends divided by its EBITDA, debt has been cut by 42% since the merger. Today, the maker of Coors Light and Miller Lite has about $7 billion of funded debt. This includes $5 billion in U.S. dollar bonds, $800 million of euro bonds, and $1 billion of Canadian dollar bonds. So even though EBITDA is down near $2.1 billion, net leverage has improved almost 2 turns to just above 3 times.
So how are things shaping up for 2022, the rest of the year?
Yeah, so in 22, Molson expects sales and EBITDA to rise, so this will be the first time since the merger. And as it continues to prioritize lowering debt, we think net leverage could drop to 2.7 times, and that puts it well within solid BBB territory. This is 1 notch above its current bottom BBB range. S&P indicated to us that it needs proof that Molson can sustain margins and continue to improve via innovation. S&P also said that Molson has exceeded expectations in its ability to execute, and thus could raise Molson's rating outlook to positive from stable in a few quarters as the first step toward an upgrade. S&P also considers the downside risk to be low. We think upgrades may occur in 2023.
Let's talk about inflation. We are seeing rising housing prices, rising oil prices, of course, off the war in Ukraine, even more pressure when it comes to food prices and a lot of the input costs for a lot of food companies, for beverage companies like Molson Coors. Talk to us about how Molson Coors is positioned this year specifically in light of the war in Ukraine.
Yeah, Kriti, so this is a very, very good question. This is top of mind for investors. In the U.S., Molson Coors, this is their largest market. It's about 70% of sales, and they hold the number 2 share in beer, or about 21% as they report it. That's about half the share commanded by the king of beers, AB InBev, known for its Budweiser brand. Key input costs for Molson include barley, hops, aluminum, bottles, and corn. Plus, they're experiencing higher transportation and labor costs, including shortages. But going back to these main inputs, as you were highlighting, especially with Ukraine and Russia, barley, other grains, and aluminum, they're up 40 to 60% year on year. But Molson expects to offset most inflation headwinds with higher sales of higher margin above premium beer and what it calls its beyond beer category, which is mostly comprised of seltzers. But also price increases are helping. In the first quarter, Molson raised prices 3 to 5%, and it could institute more if necessary. For hedging, management indicated it's very comfortable with its coverage in 2022 because it usually hedges over 3 years, with the most coverage in the first year, a little less in the second, and even less in the third. That's why they think they're well positioned this year. And then there's $110 million in cost savings. So when you take all these together, Molson's EBITDA is still expected to be up, but less than the anticipated mid-single-digit rise in sales. So that means their margin is going to be down. But going back to this high cash conversion, and to give you an idea, it's almost 40% of EBITDA after dividends, debt may go lower. And according to our sensitivity analysis, even though Molson anticipates higher EBITDA this year, if things get worse, greater than expected, it could withstand as much as a 6% hit to its EBITDA and still achieve net leverage target below 3 times. So they do have some cushion.
Fascinating stuff. Bloomberg Intelligence analyst Mary Ross Gilbert, we thank you, as always, for making the time for us in your very busy day. Coming up on the program, we dig into earnings even more, this time focusing on the oil and gas industry. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the Bloomberg terminal. I'm Kriti Gupta, in for Paul Sweeney. It's 39 minutes past the hour. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
I'm Kriti Gupta, in for Paul Sweeney. We want to take a look at earnings now, this time with a focus on the oil and gas industry. For more, let's welcome Bloomberg Intelligence senior energy analyst Vincent Piazza. Vince, let's start with Pioneer here. This is a company that has a huge share of the Permian Basin, where a good chunk of the oil production in the United States happens, essentially. But I'm curious about the ramp up in production here. This is coming at a time when there's a lot of concerns about the legacy that COVID has left behind, squaring that with the surging demand coming out of Europe and arguably Asia as well. How do you square the two?
So we went from a period of extraordinary growth, production growth for the upstream industry. But despite that, the industry was outspending its cash flow. We've switched that to more of a disciplined approach to not only spending, but also production. And what we have here is a much leaner industry, a more concentrated industry, and a more focused industry around discipline, spending discipline, and production discipline, which is allowing the industry to throw off significant free cash flow. Q1 should be a strong start. You mentioned Pioneer. They are a key operator in the Permian Basin, the Permian being a legacy oil-centric play. The industry overall should see strong free cash flow in 2022. To give you an example, Q1, we're looking at the names that we cover, throwing off roughly $22 billion of free cash flow in Q1. For 2022, that's north of $94 billion. So a strong 2022 on the horizon for the upstream industry. The real question is, and the real question that we have at BI is, what's the best way to repatriate that excess cash, and how do we move forward? We don't think that the industry is going to double down and go back to its old ways of overproducing or outproducing its capacity. We think the industry will maintain a steady pace of output. That is what the shareholder base is rewarding now. It is rewarding a more concentrated focus around spending and repatriating excess cash. It's not rewarding overproduction.
Well, that's interesting to me because, how do you make that extra profit, right? It's to perhaps increase your exports, ramp up your production. At least that's the argument when it comes to a lot of people looking to perhaps reclaim market share from the American shale sector. But Vince, I'm also curious about, as you mentioned, a lot of these companies have a lot of cash on their balance sheet, historic profits, actually. I'm curious how that factors into the buyback picture. Do you see a lot of these oil companies buying back shares?
So we do not favor buyback initiatives. We don't think buybacks really change the fundamental outlook for these companies. It may engineer financially better unit earnings, but it does not change the overall health of the franchise. I don't think it sustains shareholder engagement. What drives shareholder is the repatriation of excess cash via building up of the base dividend and supplementing those base dividend payouts with supplemental payouts. The industry overall has a very anemic dividend yield, but the free cash flow yield is somewhere north of 15% in 2022. So there is some catch-up. And we think that the industry will turn more toward these base and supplemental dividends in 2022 and rely less on the buybacks. In the past, and we've done this research looking out over the last 5 to 7 years, the industry has not picked prices well at all during their buyback binge. In fact, when prices were low during the COVID crisis, really no one bought back any shares. So we think the best way to reward the shareholder is to acknowledge higher base dividends and higher supplemental dividends and back away from share buybacks, which are just transitory, and they do not change the underlying fundamental financial health of the organization.
Vincent, about 30 seconds here. I'm curious what happens when oil prices inevitably drop, whether it's in the next couple of months, whether it's 3 years down the road. How do these companies keep equity investors interested?
Well, we think the best way to do this is by this disciplined spending approach, improving the balance sheet, which they have done, boosting liquidity, which they have done, refinancing and pushing out maturities, which they have done as well. Leverage is quite low overall for the oil and gas space, and we think they are much better positioned to withstand a downturn in the industry when it does occur.
Well, Bloomberg Intelligence analyst Vincent Piazza, a wealth of knowledge when it comes to the oil space. We thank you so much. Let's stick with earnings now and shift focus to the hotel and gaming industry. For that, we bring on Bloomberg Intelligence analyst Brian Egger. Brian, let's start here with MGM. We know there's this massive reopening to some extent, although perhaps the stock market not necessarily taking that into account, just given the latest supply pressures, the COVID issues. But I'm curious about what this means for MGM's business. Is it seeing that ramp up? Are we back to 2019 levels?
So I think Las Vegas is, generally speaking, getting there. You know, gaming revenues have gone a long way to closing the gap versus 2019 pre-pandemic levels. And we are waiting for stabilization and improvement in things like convention bookings, which I think we'll see more of in the second half. But Vegas has made a reasonably solid recovery. We're seeing in the other part of MGM's business in Macau and Asia, quite a bit more steep declines for a number of other structural and travel-related reasons in Macau. But basically for the U.S. businesses, and that includes MGM's regional properties, businesses has come back quite well compared to pre-pandemic levels.
See, this is fascinating to me because I'm wondering, even if they're perhaps haven't fully come back to pre-pandemic levels, how much of a margin are some of these gaming companies making?
So, that's an interesting question. One thing that will happen as conventions begin to return is that roughly 20% of the room nights of a company like MGM in Las Vegas that were historically occupied by conventions, will see those customers come back. During the downturn in the pandemic, a lot of those rooms, because conventions generally weren't being held, were occupied by lower spending leisure guests. So there should be some benefit from a margin perspective, particularly for not only casino margins, but also food and beverage and hotel margins related to catered banquet functions and other things. Those things should start to come back alongside any kind of recovery we see in the convention activity, which was really pretty much dormant during the worst of the pandemic.
Let's talk about the China of it all. I believe there's been recent kind of pullback on some of the regulatory scrutiny on the gaming in China. How much of that is still an issue?
So, the big challenges that companies like MGM and their rivals face in Macau in particular going into 2022 are really twofold. One is that there are certainly travel restrictions that remain in effect. We're seeing, even steeper declines in revenue per available room, even in the hotel sector in Asia and China than we're seeing in the U.S. So there still are travel-related restrictions that are quite problematic. The other thing, too, is that within Macau, the junket activity related to VIPs, that business was largely discontinued in December. So we're kind of entering 2022 with a much greater reliance on the mass market business, with the expectation that the high-end junket business, extending credit to bring in high rollers, much of that business will be pushed to the wayside as we go into 2022.
I'm looking at some of the debt picture when it comes to Marriott and Hilton. Marriott, I'm noticing, has quite a bit of debt, corporates and loans due in 2024. It kind of feels like perhaps they're racing against the clock in terms of this travel recovery. Give us the significance. How prepared are they to pay down some of this debt?
So, I'll give you my perspective, generally speaking, on maybe I'll talk about more in terms of capital returns. But I think the good news is that for certain parts of their business, and as mentioned earlier, leisure, North American travel, things are well back on a way to recovery. I mean, I will give you some insight into this. Marriott has said that they expect to be in a position, as long as this kind of RevPAR recovery continues, to begin to reinstate capital returns, share buybacks and dividends that have been suspended during the pandemic. The hope is they can reinstate some of those returns in the second half of 2022. So, barring any other significant dislocations, and assuming we continue to see the kind of sequential recovery we've seen, I think the company should be overall in much better shape, because we are beginning for certain parts of the business to turn back to what we had seen pre-pandemic in terms of RevPAR levels. And along with that, as other segments of the business recover, that'll not only benefit RevPAR, but that'll benefit margins and obviously the ability to both manage capital returns and debt service.
Well, Bloomberg Intelligence analyst Brian Egger, thank you so much for bringing us that insight on gaming and hotel earnings. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. And remember, you can access Bloomberg Intelligence via BI Go on the Bloomberg terminal. I'm Kriti Gupta, in for Paul Sweeney. It's 57 minutes past the hour. This is Bloomberg.